What's up, everybody? Nate here, and the Federal Reserve just released its meeting minutes from its last FOMC meeting back in September, and it's kind of a doozy.
Here we go again.
Basically, the Federal Reserve admitted that they are very surprised and kind of shocked that inflation is still highly elevated in our economy, despite them actually raising their interest rates very quickly and aggressively pretty much all throughout 2022. At that same meeting in September, the Federal Reserve raised its benchmark interest rates by 75 basis points. This is the third consecutive time that they've actually done this, and that means that the federal funds rate now sits well over 3%. They talked about where they expect their interest rates to go from here. They talked about their expectations for our jobs market and economy, and today I want to break this all down and kind of go over what exactly all of this is going to mean for our economy, inflation, and the jobs market. All right, so I want to start with a direct quote from the Federal Reserve. Their open market committee members actually said, quote, "Participants judged that the committee needed to move to and then maintain a more restrictive policy stance in order to meet the committee's legislative mandate to promote maximum employment and price stability." All right, so let's go ahead and break that down. What exactly does the Federal Reserve mean by maximum employment and price stability? So maximum employment is kind of an interesting concept when we talk about the Federal Reserve. Now, the Federal Reserve wants every available person that can work in the United States to be working, so that way everybody has a paycheck. And if everybody has a paycheck in their mind, then we can't really have an economic recession or a slowdown because everybody's going to be making money. But this has to also be in line with businesses, because companies can't just create positions that don't really make any sense just for the sole purpose of hiring people and paying people. That means inflation is going to go up, and it means that people are going to be buying way more than they're probably supposed to. And the Federal Reserve is worried about companies overpaying people. And we have seen companies start to overpay people because of things like the Great Resignation. Companies in 2021 wanted to hire people to kind of alleviate a lot of our inflation and supply chain problems, but not only that, they needed people in order to grow their business. With so much capital and liquidity going on because of quantitative easing and, of course, money printing from the federal government, and not to mention the low interest rates, that meant that businesses were gaining all of this extra money very, very quickly, basically all at once. So they were growing, and they wanted to grow as fast as they possibly could. But according to the Federal Reserve, they probably overhired people, and when they did that, they paid them way too much. That is working to create the second problem that the Federal Reserve is addressing here: price stability. Prices can get out of hand pretty quickly in an economy if you just have way too much money going around all at once. There has to be some kind of limit to supply and demand, because if you give out way too much money, then people are going to continue to buy things at an unprecedented rate, and that's exactly what they did over the last 2 years. I mean, just look at the stock market or the housing market, or if you even just walk into your local grocery store, everything is going up in price, and that's because producers have to pay a whole lot more, and they kind of trickle those costs down to the consumer at the end of the day. When companies have to pay more to produce things, well, that includes paying people an additional salary, and it means opening up new locations in order to meet demand. And when all of that happens way too quickly, that means that these businesses have to give their employees a pay raise. Now, obviously, employers kind of give out pay raises at a certain point. Typically, pay raises go up by around 2 or 3% every single year. This is what meets up with inflation. And as costs rise for businesses and they pass those costs down to consumers, consumers then need to make more money, because if they didn't make more money, now they're not going to be able to afford all of the products that they could before. So businesses turn around and give them a pay raise. But that kind of creates an interesting situation, because now consumers are buying more things, and producers need to kind of create more in order to meet that demand. That comes at a cost to them, though, and then once again, they trickle those costs down to the consumer. This is called the wage price spiral, and it can get out of hand if you do not have price stability. So here's exactly what the Federal Reserve's plan is for 2022 and 2023 to kind of solve both of those two problems. Now, the Federal Reserve has a monetary tool with its interest rates. Its interest rate policy is going to determine how much demand and how much supply you have in an economy. When they raise their rates really high, then that means that it's really hard for businesses and consumers to take on a lot of debt. People can't go out and get a mortgage if interest rates are really high. You're basically going to be cut off from the mortgage market simply because interest rates are high. And that translates to businesses as well, because investors are not going to be able to pour as much money into a company because they can't take on debt. This is one of the easiest ways and one of the most simplified ways that investors make money. They take on debt, but they don't buy something that is going to lose them money. They invest something that is going to give them a higher return rate than what the actual debt is. So say an investor takes on debt for 3% interest while their investment might make them 6% or it might make them 10%. So they're okay with taking on that debt. But right now, with interest rates going up, investors don't want to take on debt from the US government or any bank for that matter because they're not going to see that huge return on their money. Sure, some investors are, but it's definitely going to be fewer and far between. Now that kind of enters into businesses, right? Because these businesses survive off investor capital. They can't solely rely on sales because what if sales stop coming in? No, they use a lot of that investor money to grow their workforce or invest in their industry. You can pretty much see this from the startup level to the IPO stage to your big Fortune 500 companies, and they need this money in order to survive. But without that cash, what exactly are businesses left with? Well, they're left with trying to still make a profit, but they have to kind of cut their costs in order to do that, i.e. people.
I feel terrible.
The Federal Reserve wants to kind of fix this maximum employment problem by forcing companies to eliminate positions and close a lot of their job postings. They're not going to be able to find and hire a lot more people because they just don't have the money for it. That in turn is going to make unemployment go up in the United States. But again, this is a designed solution from the Federal Reserve. They don't want as many people employed because this is their way of making sure we have price stability. That will kind of ensure that we have maximum employment in the United States because now businesses can't just hire people for no reason. They actually can only keep the amount of people that are going to increase productivity in their company. And as unemployment starts to rise in the United States, the Federal Reserve can ensure price stability because now demand is coming down for everything. People aren't able to spend as much money because they don't have an income anymore. So that means that prices are once again stable. And this is exactly what the Federal Reserve wants because prices for consumers and producers are going up at a rapid rate and they're way too high right now, which is causing businesses to pay people a lot more. People make more, businesses have to produce more, and it's just a big problem. So the Federal Reserve during its next meeting in November is most likely going to raise its interest rates. They believe that they need to continue to raise their interest rates in order to cool the labor market. That's exactly what they want to do. They want it to be a whole lot looser rather than extremely tight. Right now we have a very tight labor market because pretty much everybody in the United States that can work is working. Unemployment is around 3.5%, a near low, and every single time this has happened in American history where we have very, very low unemployment, it typically goes way up because when unemployment is low, inflation is typically very high. So the Federal Reserve starts to raise its interest rates and that makes unemployment go up. Now, how far that actually goes up is going to determine what happens with our economy in the future. If they start to raise rates very aggressively and very quickly like they are right now, that could mean unemployment actually spikes very quickly itself and it almost doubles over the next year or two, which would also mean that the United States practically goes into a recession. And that's actually if you consider the United States in a recession right now. The first 2 quarters of the United States saw GDP actually shrinking. So we don't have the numbers for Q3 yet, but 2 consecutive quarters of GDP going down shows that you are in a technical recession. Meanwhile, the Federal Reserve is tightening its monetary policy, which is restricting the economy even more in terms of spending and business growth. So that could cause unemployment to go up and it's going to cause us to potentially tip into a recession because nobody is able to spend any money. And this could also bleed into a lot of other markets in the United States, like the housing market. People are not going to be able to afford their houses, meaning houses are going to go into foreclosure and there's going to be more supply, so prices in the housing market could go down. In the stock market, global equity markets are already starting to go down because think about what a stock is. Those are shares of a company that people are buying, but they don't want to buy shares in a company that is cutting workers and losing profit. So the stock market is going to show some repercussions because of that. And not only that, but it makes the US dollar a whole lot stronger when the Federal Reserve raises its interest rates very quickly. Because the US dollar is very strong and it's not circulating as quickly around the world like it used to, now US dollars are harder to come by, which means profits are smaller for global companies and US businesses. For the entire year of 2022, the Federal Reserve only predicts US US GDP to grow by around 0.2%. Now, considering as fast as we grew over the last couple of years, this is the biggest drop in GDP that we have seen since around 1984. But what you got to keep in mind from what happened over the last couple of years is there was so much money. There was around $3 trillion or so in circulation at the start of 2020, and now there is well over 20 trillion, meaning the Federal Reserve has been busy with the money printer. They've been printing a lot of money, and yeah, when you print money and you lower your interest rates, that's going to mean the economy grows, and it grows very quickly. The problem is prices are also going to get out of control because of inflation. So the Federal Reserve kind of is constantly riding that line between growing the economy too quickly and sending it into a recession. This is all done with their monetary policy, and this is something that they're going to have to consider moving forward. Now, they also mentioned in their minutes report, because of their policy decisions today, they do expect inflation to recede in the coming years. And with that, their benchmark interest rates might be at around 4.6% by the end of 2023. That is 4 times higher than what they were at the start of 2022. But I want to kind of give you one caveat to this entire economic discussion. Now, me talking about the Federal Reserve raising interest rates and causing a recession is not to scare you. What you have to remember is that the entire US economy was drastically overinflated in 2020 and in 2021. I mean, printing $17 trillion in the blink of an eye is not something that you do every single year. The only reason that they did that was because they weren't sure what was going to happen with the pandemic. They weren't sure if they were going to have to continue economic lockdowns for a very long and extended period of time. So they wanted to grow the economy artificially because nobody was really working. That had consequences though, and the consequences were really high inflation and everything being pushed up to its maximum. The stock market hit a record high. Housing prices hit a record high, and every other industry that you can probably think of hit a record high. Now we are coming back down from those record highs, and in my opinion, I think we're just coming back down to what is a normal level. Even before 2020, remember, the Federal Reserve was raising interest rates in a response to the Great Recession of 2008. Now, that happened in 2008, and the Fed didn't really start raising interest rates again until 2019. So all of this massive business expansion has grown over the last 10 years because of really low interest rates and money printing. But now the Fed is flipping the script, and it's time to get back to normal economic conditions. Now, I nor the Fed do not know how long that's actually going to take, and we don't really know what exactly is coming next for the United States economy. We can predict, but I don't have a crystal ball in front of me. I can't tell you exactly what is coming next. But what I can tell you is that the Federal Reserve is worried about inflation. Their goal is to bring inflation down no matter the cost. They do not care what happens to our economy right now. They have a duty to the United States federal government and the United States dollar to make sure that the dollar is relatively strong on the global stage, and that means bringing down inflation quickly. So I can almost guarantee you that inflation is going to come down in our economy over the next few years, but not without, and I'm using the Federal Reserve's term here, some pain ahead.
Might be some problems later, but we'll cross that bridge when we come to it.
But now I want to hear from you on this issue. What do you think about the Federal Reserve's most recent meetings report? Do you think that them keeping interest rates really high and extending them for a long period of time is the right move to bring down inflation and better our economy for the future? Or do you think that this is going to cause an outright economic collapse and a full-blown recession? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.